Welcome back to Morning Trade Live. We're having some fun here talking about the big stories, but right now, maybe not so fun of a story, is the growth forecast for the world in 2019. Already under question by investors now. Goldman Sachs saying it's going to be closer to 2%. We got Steve Rashes and Scott Bauer joining us in studio from M1 Capital Management and Prosper Trading Academy, respectively, and Stephanie Lewicki from TD Ameritrade. Scott, let's talk about this. Goldman's saying, look, things are not robust next year, and they're not going to be as robust as we thought, basically, dialing it back down to like, what, 2%. So what does this mean for markets? I mean, at the end of the day, isn't this what it's about?
It's a good thing. I think this is a great thing that they came out with it.
Okay, how so?
Because we're finally starting to see some of the big guys, whether it's Goldman, JP, some of the other big houses out there, say, you know what, things are still pretty good, but we're just dialing it back in a little bit here. We're pulling the reins in a little bit. And what I think that does is it sets the market
bar lower?
Yes, it sets the bar lower. Now, when companies come out and they have those, expectations, earnings are going to be what they're going to be, but it's really going to be, again, what they say moving forward, what they say about tariffs, what they say about inflation, this, that, and the other. I believe, especially now that we're seeing the herd, the herd mentality kind of out of there and dialing expectations in a little bit, I think that sets the bar for the market to actually, I don't want to say explode. I think we have a great move higher for.
So you're seeing the possibility of a surprise to the upside then gets greater as the expectations get lower.
Yes.
And that's fair. That's good logic. It's sound. However, let's take the other side, Steve. I'm going to put you on the other side if you want to play ball. 2.4 was Goldman's expectations. 2.4% down to 40 basis points of GDP growth. That's a pretty big deal.
Yeah. No, I agree. You're not putting me on the spot being the contrarian bear.
Right, well, that's why.
So I'm comfortable with that role. But I think there's a bigger fundamental picture here that's causing angst in the markets. And there's no question from a valuation perspective, things look better here. We don't know how these trade wars, so to speak, are going to play out. But what investors clearly think now is that the first 6 months of this, when it first started with the administration, it was kind of a game. Like, okay, we're going to throw some hand grenades in the pool, we're going to shake things up, and we're going to try to, use that as a way to negotiate a better position. Okay. So now people are scared of that tactic because what they're actually doing is implementing the things that almost every economist, no matter what political stripes they wear, say
tariffs
are pretty much the dumbest thing you could intentionally do for an economy. So the market right now doesn't know how that's going to play out. It could resolve itself in a positive way, or it might not, because let's say politically the administration actually looks at China as an adversary. Yeah. We don't know these things, so that's where the uncertainty comes in. Is there has to at some point be a certainty for the markets to stabilize and for the volatility to come in a little bit. Even if that certainty is bad, at least we'll know what it is. So the resolution of this can't be aggressively positive tweets followed by no actions.
Sure. So that's a good point as well there, right? The logic there is also sound, where when you hear tweets, and also the Xinhua Chinese news agency also reported there was progress being made. If that doesn't turn into real progress, could mean volatility for markets. I don't doubt that. However, what's interesting here, Stephanie, is when I look at the report on the Goldman cut for their growth, there's more about non-tariff items than tariff items, was my conclusion from it, where it's mentioned in there, but to me it wasn't the front and center story, where it was more kind of a cyclical type of slowdown, which means that then we have to think about, all right, well, what could be those surprises? I mean, what was your takeaway from this?
So the one thing, too, they said they cut this for the first half of 2019.
Yeah.
So at least it wasn't for the whole year. They're cutting it right now. They're taking kind of, I think, more of a conservative approach and just saying the first half, we see slowness. We're cutting it 40 basis points.
Because the second half, they already had it like 2 or less.
Yes. So again, besides China trade, there is the Brexit issue. There is the Italy concern. Although I think they did come to a conclusion there, there's still, I think, probably going to be some fallout from there. There's numerous. We know global economic growth is slowing. Numerous organizations, companies have been cutting global growth across the board. The emerging markets, we do have crude. What is going to happen with crude in 2019? Yeah. I think there's a lot of items that are out there besides the trade tariffs, but I do think it's going to be really fascinating, interesting to see when these companies report earnings in a couple weeks, what they're going to start saying about the tariffs, if they're even going to say that much, because you know
Totally
what?
agree.
We don't really know anything yet, anything more than we did when they reported last quarter.
Yeah, Scott, I'll give you the last word because I think that's been a huge point. Is basically what concern about the economy is a natural slowdown after years of slow, steady growth, and what is specifically catalyst induced by trade. I imagine the answer to that question could be very important for markets.
It is, Stephanie, you hit a great point, is that this Goldman report really addresses the more macro picture without the tariff talk. So if it is a natural progression, if it is a natural just ebb and flow slowdown of the economy, that's actually good. Fundamentally, that is good for the economy, that is good for the markets, and that's what I see as very positive in this report. From the tariff perspective, Steve, like you said, yeah, it is just a blanket question mark out there. We don't know what's going to happen. Nobody wants to believe the tweets anymore, this, that, and the other, until we actually see something happen. But I am very positive about this Goldman report because it is more fundamentally based.
Hey, it's definitely the opposite of this time last year, which was synchronized global growth, everyone jump in, everything. So at least the bar certainly has changed heights. Steve Ratchis, Scott Bauer, Stephanie Lewicki, really good conversation here this morning. Want to head out into the TD Ameritrade newsroom. Tom Light with an update. Tom, fast market, what's going on?
We're going to hit the bank.